Welcome to the Bridge Capital Market Observations Call for the week of May the 22nd, 2023. I'm your host, Eric Jefferson. Going to kick things off as we do, recapping last week. Although before we get started, a few quick words from our legal team. With that, we can go ahead, dive right in. S&P up over 1.5%. Major contributor was the expectation that a deal to resolve the debt ceiling would get done. Initially, conversations were very constructive between both parties. Granted, have stalled a little bit as of late. Expectation, though, certainly that something is ultimately resolved. There would be catastrophic implications if it was not, and the U.S. government, as a result, defaulted on a debt. I don't believe any politician wants their name written into the history books with that legacy. However, in the other vein, no motivation necessarily to get a deal done prior to a deadline if you think that you can get your party better terms. As a result, we've seen these often be resolved in the 11th hour. That being said, puts that much more pressure and potential risk if we wait till the last minute and somehow things fall through the cracks. Part of what got us here, certainly there have been decades of continued spending in excess relative to what we would bring in. Specifically, though, as of late, we saw tax receipts come in April, far less than originally anticipated, so that moved up the deadline. We're currently looking at June 1st X date, or when we would, in essence, no longer be able to fund the interest payments on our debt. Part of the challenge there, that isn't a specific figure. That is only an estimate. The exact date we wouldn't actually know until we got there, which puts that much more pressure and urgency to get something resolved. Imagine if we went into that 11th hour without a deal, could likely see an uptick in volatility. As I mentioned, it has been very interesting, though, just when we look at the market that has time and time again exhibited its resilience or almost sort of complacency here. Right now, the market is telling us that no need to worry. This will certainly be resolved. And so either the market is right or it is likely set to meaningfully reprice. Again, all expectations are that we get a deal. That being said, if it goes to the 11th hour, though, potential for some elevated volatility. One interesting stat, if we look to the derivatives market, there are instruments where you can use to hedge against defaults. And currently, if you look how credit default swaps are pricing, the US is viewed as being a riskier or more likely to default on its debt than the likes of Brazil, Mexico, Greece, Bulgaria, Croatia, all beautiful countries and places to visit. Not necessarily, though, the names you want to be associated with when we think about the probability of fiscal default. Now, fast forward, once we do have a deal in place, unfortunately, it's not that we're simply able to move on. Assuming there's a deal with some sort of spending cuts baked into it, as a result, we would lose a key piece of the economic growth engine. Obviously, that is going to therefore reduce the natural tailwind for GDP and in all likelihood, increase probability of recession. Granted, though, if no deal or no spending cuts are baked into any resolution, in all likelihood, expect debt to continue to skyrocket. We are approaching 120% debt to GDP ratio. That is the highest that has been since World War II. And again, something that is not sustainable long term. As we talked about, the market has been incredibly resilient year to date. Part of that is there was a lot of pessimism going into this year. Earnings expectations were in the basement, a lot of concerns over recession, over continual hiked interest rates. And so what has, interestingly enough, been the catalyst or driver of performance is that things have not turned out to be as catastrophic as initially feared. Again, when we think about the economy, by virtually all accounts, it is losing momentum. Leading indicators now down for the 13th consecutive month. Granted, that has never happened without a recession. However, current levels, are far from 2008 depression levels. And so where many expected things to be far worse than they actually are. That in turn has sparked a little bit of optimism. The best analogy you could come up with, let's say the forecaster, suggests it'll be negative 20 degrees out. If it turns out to only be -5, that is warmer than expected. But again, by no means would anybody consider -5 to be beach weather. The second piece, when we think about the consumer, they're important. They represent 70% of the economy. We've seen a lot of softening there by virtually every metric. We heard that confirmed by a lot of retailers on their earnings calls, lowering guidance, suggesting folks are coming out spending less. That being said, we've not seen a collapse in any way. So while things are slowing, are not necessarily getting better, and the same vein, they're not getting as worse or not materializing to be as bad as initially thought. All of that in turn, where we do have some improvement in data, you've seen the market rally, and what that's also resulted in, folks that have been on the sidelines are now forced to jump back in, whether they want to or not, due to fear of missing out. In turn, more buying only continues to send prices higher and higher. That is a concept referred to as the pain train, which is certainly very real in this current environment. As we think about the S&P 500, interestingly enough, though, one final stat I wanted to spend a moment talking about. The average stock is up over 2.9%. That's interesting relative to the index itself, up roughly 3 times that. The index is market weight rather. So the weights are a function of the cap size of a company. In essence, what that means is it overemphasizes the performance of larger companies. And interestingly enough, year to date, this rally has meaningfully been led by the 10 largest companies. If you strip them out, the average stock in the S&P drops to 2% from 2.9. That is over a 30% decline in performance. Again, those 10 largest companies, very much heavily concentrated in the mega cap tech sector. That's one that has rallied based on certainly these AI conversations, based on the expectation that interest rates would likely not be ticking higher, although that is still less of a sure thing at this point. And with respect to the portfolios, 2 series of trades would like to quickly mention for those invested in our ETF portfolios. We recently shifted our equity exposure into higher quality companies, those that if we did have some volatility ensue, would anticipate holding up a little better, as well for a sector play allocated to Japanese equities. That is a region of the world that has struggled for decades, although we've now seen them large in part due to some new leadership. We've seen some very strong growth potentials, as well, much more favorable valuations where the cost paid relative to those expected earnings. That position is currency hedged, so no concern if the US dollar continued to rally. That would not necessarily be a headwind for those international exposures. For those folks invested in the individual stock portfolios, we've added some additional screens that filter out some of those truly more volatile boom or bust type positions. The thought process being that then results in a smoother, more consistent return experience going forward. Obviously, we've gone back, done a lot of hypothetical back testing. Those additional screens turned out to be very encouraging or increasing to the bottom line metrics as well. That's all for this week. As always, happy to discuss anything in more detail. If you don't connect, have a great rest of the week. Take care.